Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, December 15th, and I'm recording this from our studio in Purchase, New York. One of the biggest and most underappreciated surprises of 2025 has been the extraordinary outperformance of emerging market equities. So far this year, emerging markets have returned more than 28% versus 16% for the S&P 500 index. The weaker U.S. dollar certainly helped emerging markets, but the fact that they have done so well in a year with massive geopolitical change and an aggressive new tariff regime from the U.S. strikes us as impressive. So the question now is, could emerging markets be entering a multi-year period of outperformance? Several developments have solidified our interest in this asset class. First, valuations remain attractive. Despite this year's price gains, equity valuations in emerging markets are still at historically wide discounts to those in the U.S. Yet the earnings growth gap with the U.S. is expected to shrink over the next 2 years. Earnings growth forecasts for emerging markets average 12.5% for 2026 and 11.6% for 2027. We would also note that upside economic surprises, which can be positive catalysts, have been higher in emerging markets than in the U.S. this year. Second, the trade confrontation between the U.S. and China appears to be cooling. With both sides seeming to acknowledge their interdependence, the truce could last through the U.S. midterm elections. Although China is not the only story in emerging markets, a fact that many overlook, we think that this stabilization should provide a foundation for prosperity in emerging markets for next year. Third, the infrastructure needed to support generative AI, from chips to electronics, manufacturing to power generation to construction, is boosting demand for industrial metals and commodities, many of which are produced in emerging markets. Copper has gained 35% this year and aluminum is up 13%, creating nice tailwinds for Latin American producers such as Chile and Argentina. At the same time, record-breaking rallies in gold, silver, and other precious metals have led to similar windfalls for producers in Mexico, Brazil, and Peru. Though not as good for producers, oil supplies have been ample, which is a huge positive for energy importers like India and China. Finally, the White House's new foreign policy framework, or the National Security Strategy, makes clear the U.S. will aim to influence and integrate the Americas. Called the administration's New Monroe Doctrine, it suggests that the U.S. may back new opportunities for trade, supply chain integration, and foreign direct investment that would directly benefit Latin America. Over the past 15 years, overweighting the U.S. has served global investors well. However, profound changes in geopolitics, monetary and fiscal policy, as well as technology, along with rising debts and deficits in the developed world, are creating a need for portfolio diversification beyond just U.S. stocks and bonds, especially for long-term investors. One of the most attractive opportunities for this diversification may be in emerging market equities. Consider rebalancing for maximum strategic asset allocation diversification while avoiding single stock concentration. Also consider taking profits in high beta, unprofitable, small, and micro caps, as well as speculative equities, where gains could be vulnerable in 2026. We would redeploy to large cap core and quality stocks, including the Mag 7 and the generative AI productivity beneficiaries in sectors like financials, healthcare, and energy. Finally, we suggest adding to rest of world equities with a focus on emerging markets. As always, thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.